Well, good morning. And I wanted to say thank you for joining us here on the Money Advantage podcast. Welcome back to another episode. And today we're going to be really just talking about how to consider your options financially. And there are so many different ways of thinking about money, thinking about personal finance, and being able to accomplish your goals. Everyone has targets that they want to reach, whether that's a certain income dollar amount at a certain time or a certain net worth amount at a certain time. And what we're going to do today is really just unpack some of the reasons why the typical way of thinking about financial planning and money and preparing for the future has some challenges that you may not necessarily be aware of at this time, and how to consider additional options, how to think about really what you want to accomplish financially and get the best results, whether or not that is something that you've heard of before. So sometimes when we are trying to reach certain goals, it's easy to do what we've always done or what someone else has done before us or what everyone else is doing. And today, what we're going to do is really just talk about personal finance from the lens of helping you to understand that you have a lot of options that might be outside of the scope of what you've done in the past, or what the person next to you is doing, or what the majority of people are doing. Bruce, thank you so much for joining me for this conversation today, as I think this is a really good opening or door opening into just a new way of thinking about money and finance in general.
Yeah, I think the first thing that we need to talk about is financial planning has different definitions to everybody. Financial planners, advisors, insurance agents, brokers, all these things have different meanings to everyone. And what happens, I think, in the American psyche is we don't take the time to actually educate ourselves to become the best financial advisor that we can possibly be, and that's ourselves. I'll give you a great example is one of my colleagues heads up our 401k team here at our firm, and he's a younger guy. He gets so frustrated because he will set up a day where he will go to the company to meet with the people to go over their 401ks, and maybe only 4 out of 30 to 50 employees will actually show up.
Mm.
And he's like, I cannot believe these people aren't, paying attention to their finances. And the fact of the matter, the American people, for whatever reason, we can unpack those psychological reasons. Um, they don't really pay attention to it. And then when they start thinking, well, maybe I should pay attention to it, they start thinking, well, I am going to get my advice from TikTok, or I'm going to get my advice from Instagram, or get my advice from YouTube, because I don't want to look silly in front of somebody asking questions. It's one of the things that I do as an insurance agent, as a broker, as an investment advisor myself, is try to put people at ease and say that there is no such thing as a silly question. Everybody has these questions. You're not confident enough to ask these questions. So as we start to talk about typical financial planning, we're not saying that typical financial planning cannot work, but oftentimes it works just because of ad hoc reasons or the time period that you're in. Other times, traditional planning, you can do everything, perfectly, but if something happens major in the world, it might not perform the way you want to perform. So you really need to put guardrails on according to your risk tolerance and your understanding. Well, the only way you can do that is actually to become educated so
Mm-hmm.
that you can become the best financial advisor possible. So the financial advisor doesn't understand your emotional response to money.
Bruce, I love that you said several things there. One being that you need to take ownership, but I can hear somebody saying, well, if I'm not supposed to rely on YouTube videos and TikTok, but I should be educated, how do I go about making sure that the information that I'm receiving is factual, is sound, is really going to point me in the right direction? And I can hear that question because we have so much available information or information available to us with, I mean, everything from AI to blogs on or to YouTube videos from people who are knowledgeable or from people who are just great marketers who may not have any real reason to benefit you by the video content that they're making. It's just for the purpose of gaining a lot of views and gaining a lot of traction. And so, Bruce, before we dive in, and I'm going to kind of lead us through the conversation in terms of helping somebody to think through what is typical financial planning. But before we do that, what would you say to somebody who's asking that question right now? How do I make sure that I'm becoming educated, but choosing the right education to fill my mind with so that I can become wise?
I think first thing is you have to find the answers to the questions by several different vehicles. Like you said, it could be a trusted friend, it could be an actual professional, it could be research at a library, it could be research on the internet. Heck, it could be TikTok or Instagram. What you're looking for is consistency of the message that you actually believe in. And that's the most important thing. So you look for the consistency in the message. Now, just because a message is consistent doesn't mean that that is that it's foolproof and it's always going to work, or it's the message that's best for you, because they may be taking only the numbers into effect and not the time period or not the emotion. Example, if you were to ask somebody, what should be my investment goals? And I want to get the best return for my money. And somebody says to you, oh, just 500X and just keep it in there and don't touch it, because over the history of the S&P 500, it has returned on average 7%. Okay. Well, that could be a true statement, but that is over 100-year period when your period of investing may only be 30 years. And you can pick out 30 years of time period where the S&P did not perform like that. So then that isn't your reality. So that is something that you have to look for the consistency, but then also question the consistency to see if that is actually what you believe in and your time period. But
Mm-hmm.
we often fall back on numbers because we don't want to take, and I'm not trying to disparage anybody, but we're so confused. We don't want to take responsibility for our actions to get
Mm-hmm.
educated. We just say, well, we heard this from this person. They told it to me and they were wrong. I didn't make the mistake.
Mm-hmm. Bruce, I think there's a lot of wisdom in not just taking something at face value, but digging deeper to understand why that is being said and what information it's drawing from. So, not just forming an opinion based on a blanket statement, but understanding what that actually means and using logic as you are considering all of these options. And so, I think we're going to come back to some of those ideas about how to make sure you're educated and making informed decisions towards the end. But I want to ease your mind as you're coming into this conversation today that not only are we going to help you understand what not to do, we're going to then show you what to do instead. I think there can be something so frustrating about advice or counsel or warning or risk or talking about problems of something when no one presents a solution that is an alternative to that. I mean, if you're told, well, don't eat processed food and don't eat sugar and don't eat whatever, if you have the list of all the don't things, well, then you're going to be in a position of saying, well, what do I do? How do I make positive, proactive choices? And so we're going to make sure that we cover that full spectrum today. So, Bruce, let's really start by unpacking what is financial planning. And I think this is a potentially giant question. We're going to attack and address a lot of giant questions today. But, Bruce, how would you define financial planning?
Well, before I want to define financial planning, I want to define who does quote
Hmm.
unquote financial planning. So we have what we call a fiduciary. A fiduciary has passed tests. They've basically taken an oath, so they're certified to actually give advice. Some people think that's the only person you should go to. Other people are brokers. They're transactional. So they have a product that they believe is suitable for you, and they say, "Oh, this is the best thing to meet your financial goals. Purchase this. I will get paid, and you will meet your financial goals." Then you might have a financial coach that just gives one fee and says, "I'm not getting paid on any of your assets under management or any of the transactions. You just pay me a fee, and I'm going to coach you through this mindset, the pros and cons, so on and so forth." But oftentimes they have no true financial certifications, and they don't have to because they're not selling you any products and they're not giving you any advice. They're just coaching you of the pros and cons of all this thing. And then you have insurance agents that are telling you the pros and cons of insurance related products, but they don't have uh, the necessarily the certification or knowledge of security related products. And a lot of people say, well, then who do I turn to? I don't understand. Well, my response would be, if financial planning is taken in consideration all your aspects of money. And Rachel, we can say that everything we do in our lives is actually has to do with money. Whether it's
It
listening
does.
to, yeah, whether it's listening to YouTube right now, you're listening or on Facebook, you have to have purchased something to listen to it on. Maybe you
Hmm.
have a streaming service. Everything you do has to do with money. So then I ask this question: if everything you have to do has to do with money, then how can one of those particular people or institutions I just talked to have all the answers? It's very, very difficult for one person to have all the answers
Because it's compartmentalized. And
because it's
you're
compartmentalized.
saying money is so all-encompassing in every area of our life. If you just isolate one area and call that financial planning, it's not addressing the big picture.
Yeah, because a lot of time, example, a lot of firms in the United States are fiduciary um, assets under management firms where you give them money, they actually invest it for you. They don't think about taxes. They don't think about legacy planning. They don't think about your insurance needs that can derail. They don't think about your emotion. They don't think about a variety of things in the distribution phase compared to the accumulation phase. And I was actually doing an educational event last night, and I said, "How many people like NFL football?" And several people raised their hands, but then I'm like, "Well, I don't have the whole crowd." So then I said, "Okay, how many people like baseball?" And a few more people. And then I said, "Okay, we don't have a lot of, we have some people that aren't sports people in here. So how many people like the theater to go see plays?" And then a majority of the other people raised their hand. So now I had the attention of the audience, and almost everybody was actually in one of those three categories. And so then I said to them, if you're a trying to actually work through your financial planning and you compare it to an NFL team trying to win a game, and you only went to a fiduciary planner, assets under management, they're going to say, well, the most important thing is to score touchdowns. So we're only going to play on offense. We're just going to have an offense. We're not going to have a defense. So how many games do you think they're going to win? Well, that's because their offense will eventually be disrailed, but they don't have a defense. So the other
Mm.
team's going to score on them every time. So you think you're doing a good job by saying, well, I'm going to a fiduciary. They're just going to grow my money by themselves. But if you compare it to something that you already know, that kind of sounds ridiculous. Now let's take it to the play. Let's take it to a play. And I just happened to see Hamilton twice in the last 2 months. And I said to the audience, I said, how many people have seen Hamilton? And about 60% of the group had seen Hamilton. I said, what if you saw Hamilton and you took out the actor that played the king in the play? And you said, we're going to do Hamilton, but you can't have the king, or you can't have Burr, the actor that played Burr in the play. It's going to be a completely different play, and you're not going to enjoy it the same way.
Mm-hmm.
So that would be analogous to, once again, maybe going to an insurance agent and saying, I want a financial plan that's going to have protection and guarantees, but you're going to take out maybe some financial planning that's going to actually take advantage of uptakes in the market, or you're going to take advantage of tax mitigation because you're not going to take advantage of it in that
Mm-hmm.
situation. So if you compare it to some things that people know on a daily basis and say, well, that would be ridiculous. A golf was another one I use. I said, you can play golf. You're allowed 14 clubs, but you can't use your driver and you can't use your pitching wedge for this round. Well, people aren't going to be as successful. Then now they have an estate attorney. They can't have an estate attorney. So you took your estate attorney out of the bag. Okay, you can't have uh, disability insurance because you took disability out of the bag. You can't have it. So
Mm-hmm.
if you compare it to things that you know, it's ridiculous for somebody to say a financial fiduciary can plan for everything. It's ridiculous to say an insurance agent can plan for everything. It's ridiculous to say, in my opinion, that a only an alternative investment person that does real estate only can actually meet your financial goals on a consistent basis. Once again, timeline, we've had people that said in both directions. I had my uncle got into oil in the 80s and he did great. And he's a master. He knows everything. And I also have people that said, I had a friend that got into oil. I'll never get into oil because they lost their shirt in oil. Tell me the time period that this happened. Tell me what else they were doing along the way. So a financial planner, in my opinion, should be somebody that can take advantage of all the players on the field or all the actors in the play to have the best performance overall for you. That's going to include all the aspects of place.
First, I think what's really interesting is I'm hearing you talk through what an ideal situation would be. I think the challenge is often financial planning gets reduced to something very small and not the whole picture, but just a small slice of the pie. And typically, when you hear financial planning or when we say typical financial planning, you're seeing something that is a financial planner who's managing money, maybe asking you what your long-term goals are, maybe your income, how much you can save, how long you think you're going to live, what returns you think you're going to get in the market, what risk tolerance you think you have. And I'm saying think in all of these cases because they're asking you to make guesses about what you think is going to happen so that they can use that data to then formulate into an algorithm that is going to then spit out a plan based on all of those assumptions. And the challenge is you're making a plan based on assumptions, which may or may not end up being true. So you have this foundation that you're putting a plan on that is on shaky territory. Then you typically have most people are putting money into what's called investment accounts, or they might call them retirement funds. A lot of plans are employer-sponsored plans. So you'll have things like 401ks, 403bs. You might have 457bs. You then can expand that conversation over to, well, maybe I have a IRA or a Roth IRA, or maybe I even have a SEP IRA or a simple IRA. And you're looking then at holding tanks or places where you're putting investment dollars and you're holding them for the purpose usually of saying, how do I invest the dollars within these accounts? And as you're investing those dollars, the goal typically is to balance your portfolio, have the right asset allocation so that you're reaching your target of of net worth so that you can draw off the principal or off the interest, maintain the principal. Usually you stay within about a 4% rule. I'm throwing out a bunch of things here, but what I'm sharing is that the typical conversation is often limited to those kinds of accounts where you're usually tax deferring dollars, usually they're employer sponsored plans. Usually you're in a position, and I'm saying usually, this is not always, but usually you're in a position of investing in stocks and bonds, which you're heavily weighted towards the market. And whether you're using a mutual fund that amalgamates or conglomerates, combines a bunch of different stocks according to your risk tolerance, whether it's following a particular index or how diversified that portfolio is. Really, that is the typical paradigm of financial planning. And Bruce, I'd love to have you just add anything or um, even counter anything that I shared there, just kind of to have a baseline for what we're meaning when we say typical financial planning and generally what the conversation is around financial planning.
Yeah, so the in the industry they talk about the three-legged stool. And so they say your employer sponsored plans, and you're if you're self-employed, you're the employer, so you could have those. They're called SEP or simple IRAs. You have your savings, and the savings can be other investment savings or just simply your savings in the bank, and then Social Security. Those are the three things that are typically said. If you do those three things, you will be all right in the future. Well, let's think about this now. Um, in a typical, you can be successful in that situation. Once again, it's the time period. How much you contribute to your employer-based plans? How much do you contribute to your savings that would include other investments? And then if Social Security stays on a rock solid plan and you're in the right time period, you will be successful. Some people, though, believe that going forward, that type of typical planning is going to have some challenges. Number one, we already know that Social Security is going to make some changes probably in the year 2033, unless Congress does something to mitigate those changes. And right now they're saying they only have about 75% of the money that will be paid out at that time. There's great
Bruce, let me just
sociological problems
clarify.
with that.
So, do you mean that only 75% of the committed dollars that they are committing to payout are available to payout? Is that what the 75% was? I want to understand that
If you
number.
get if you're getting $2,000, if you
Okay.
think you're getting $2,000 a month, you only get 75% of 2,000.
Okay.
You're going to lose 25% of your monthly income from
Okay.
Social Security. The employer plans, now some of them are now including Roth options so that they're going to grow tax free, but most of them still do not have a majority of the money in Roth because people are still thinking that I'm going to save taxes now and I'm going to deal with taxes in the future because they believe they're in a high tax bracket now and they're going to be in a lower tax bracket in the future. That does not take into consideration that even if that looks to be true now, we just crossed a $35 trillion debt in the United States about a month ago. And the only way that gets paid back is through taxes. The interest on that now is actually more than we spend on defense here in the United States. So somehow that's going to have to get paid back. The only way that we were able to do that is by printing more money, and printing more money is actually purchasing bonds or IOUs by the government that is actually backed by the taxing authority of the government. So let's even think you do think, and you've done some calculations. As of today, I'm going to be in a lower tax bracket. But does that mean that taxes aren't going to go up in the future? So that's a problem with typical financial. And then finally, the cash. and the brokerage accounts that are on the cash side, as we continue to print money to pay for the interest, we are devaluing the money. So if money just stays in cash, then that money is actually becoming less and less valuable. And that money used to buy brokerage accounts, although maybe the brokerage or the other investments, if it's an alternative investment, well, that's actually not typical. That's actually the next thing we're going to talk about, more traditional. The typical would not stay up with inflation. So those are really typical financial planning. And I don't blame people for following that, because that actually worked, especially it worked when there was a lot of pensions in the United States, because the pensions were actually taking place of the employer spot. They were employer sponsored, but they were employer sponsored that were actually having guarantees coming in. It wasn't until 1979 when Ted Benna actually discovered a tax incentive for highly compensated people, that many corporations actually jumped on the fact that they could get rid of pensions and replace it with a 401k or tax deferred type of benefit. That the thinking of the American people actually changed over the last 40 years.
And because of that change, there's so much that now relies on employer sponsored planning. And Bruce, what is really interesting, and I think we've touched on this here, but once you have that holding tank for dollars that are your investment accounts or retirement accounts, then those dollars have to be allocated somewhere. And usually those are allocated somehow in mutual funds, which is buckets of stocks and bonds, which is the typical conversation. So you've got some level of types of stocks that you can choose from depending on your risk assessment, and then bonds, which are more weighted towards fixed income. Can you talk about that typical spread of what the underlying investments are within that three-legged stool?
Yeah, mostly early on in your career, you would want to be weighted more towards for equities, or what we call stocks, mutual funds, ETFs, so on and so forth. Why? Because yes, they are volatile, but once again, people claim that over a longer period of time, they are going to outperform the bond market, which is true over a long period of time. There are times when the bond market actually outperforms the stock market. But people will wait a certain amount. Typically, when they're in their middle ages, it would be 60% in equities and 40% in fixed income. It's called the 60-40 portfolio. And then when you get closer to retirement, people want to take less risks, so they start shifting the equity portfolio more towards bonds. The problem with that is, when you do that, is if bonds do not perform as well as they have in the past, and you're taking the growth from the equity and putting it into bonds, it's safer, but it might not outpace inflation. And this is very difficult for a person to understand, because they want safety and they think they're safe, but they're losing buying power. It's like the old boiled frog analysis comparison, that if you take a frog and throw it into a boiling water, it'll jump right out. But if you put it into cold water and then barely raise the temperature, it won't jump out, and it eventually will die because of that. You don't see that inflation is actually eroding your portfolio's buying power, because it goes very gradually. So that's the typical movement in a typical portfolio. So they look at risk and they say, well, over a long period of time, equities will perform. Oh, look, bonds are safe for you, so we're going to move into bonds. But if bonds lose their buying power, or if they are in a bond fund rather than the actual bond, you can actually lose money. So all of these things are a dance that people just want to do, set it and forget it. That's why employer sponsored plans have moved towards what they call target date plans. So they will actually move this for you by just telling you what's the target of your date of your retirement. So if it's 40 years from now for a 25-year-old, that target date will actually have more equities in it. If it's 5 years from now, because the target is 5 years from now, it will automatically move it into more of the bond portfolio, even if bonds aren't performing at that time,
Mm.
because all they're worried about is not losing money. Yes, you're not losing money in your portfolio, but you may be losing buying power in your portfolio.
So, Bruce, this brings up a really interesting question. Can you, okay, so if we stand here in the typical paradigm that we've kind of laid out right now, the question then becomes usually, how do I do that typical paradigm well? And then you have things that come into play like, well, maybe I need to do dollar cost averaging, or maybe I need to have somebody who's really good at rebalancing my portfolio. So, can you speak to the reason why those answers are within that typical paradigm still may not be the solution that you need?
Yeah, I would say because the typical advice has been built on historicals for the last 40, 50, 100 years that are not the same paradigm that are going to go forward. What is
Mm,
now? Let's think about this. What is it? Well, we already talked about debt. We are in unprecedented debt to GDP ratio, or the total amount of goods and services that are sold in the United States. That ratio is out of whack more than it's ever been, including World War II. Um, and then you have to take in consideration that we're now more in a global economy that we weren't before. Think of e-commerce. Think of think of the ease of transportation that we have now that we didn't have a long time ago. Think about the ease of exchange of information that we
hmm.
didn't have a long time ago. But this also causes, and then think about the population has grown, that there's stress on resources, that countries all over the world are actually fighting for those resources. Think about communication that can be manipulated by nefarious people. There used to be a thing that people would do, was called um, pump and pump and drop, where you would pump up a stock price by giving out um, poor information about how great the stock was, and then that person would also buy the stock, and then before the bad information was revealed to be bad, they would already sell, and then everybody else that bought because they thought it was good information, they actually lost their butt. Well, this is actually the same thing that happens, but it happens at a much greater speed now on the internet with all this
Mm.
information. GameStop is a great example of this. That happened a couple years ago. So the fact that we can get information, you would think, is a good thing, but it's also a bad thing because people are getting information so quickly. Now
Hmm.
you also have companies on the stock exchanges that are using computer algorithms to actually change, that can move faster than the retail investor. And they will actually pay a premium to be closer to the stock exchange's computer to get the trades in even faster. When you think about traveling electricity at the speed of light almost, that they think it's that important to be in front of other trading algorithms that happens like this. So
So,
looking back, I don't think with all these other things we can take the typical approach
hmm.
going forward. And I'm going to finish this and then I'll let you chime in for just a second. But Warren Buffett's whole thing is, he says to people, you've got to buy and hold. You have to buy and hold. That's proven over the time period. Well, I say two things. We're not in the same environment that Warren Buffett is talking about. And the other thing is, you can track Berkshire Hathaway, which Warren Buffett is in charge of, and they don't buy and hold. They're constantly buying and selling things within their platform too. So it's kind of a weird advice when they're not doing the same thing.
So there's a lot of concerns that we've talked about with typical planning. I think, again, I'm going to come back and circle back to the idea that Bruce, you shared at the beginning, that a lot of people are doing typical planning because it worked in the time period that they were in. And I would say as well, I think often people are using it because it's common. It's what everyone else is doing. It's the typical narrative about how to handle personal finance. And because that is the typical narrative, it's easy to do this. So we've talked about a few challenges. We talked about overcoming inflation. We talked about the challenges of tax being unknown in the future because of the giant amount of debt in the US. We've talked about the timing of putting money into the markets and bringing money out, and what that may look like for you is different than it might have been for somebody in a different time period. So they might have won, you might lose, depending on when you're having to take money out based on your timing of retirement or when you're looking to draw that income. There's another concern that if you are just figuring out which advisor to trust and you're working with a particular financial planner, you might have more advantage by taking over some of those things yourself. Day trading or stock picking. Bruce, can you just talk to that for a minute? I think sometimes that seems like the next answer if we don't just want to rely on um, funds, large funds, or the computer algorithm as much. We want to take more control and ownership of our trajectory of financial future, staying still within the market paradigm and the market context. I know that if you're going to do stock trading, day trading, stock picking, you're going to need to be in a position of a lot of knowledge and building up that knowledge so that you can take ownership. What do you see with pros and cons of using that as a solution?
Yeah, so I think the theme that we're presenting today is that, educating yourself is very, very important. And there's not one way to do it. There's not a one size fits all. I tell people all the time, if there's one size fits all, then nobody would ever have a problem. They would never have a problem. They would just do what the one size fits all says and go on with their lives. However, because it's very, very, very complicated as far as the overall world economies and how the markets work, the markets have some predictability over a long time period, but that might not be your time period. And so a lot of people now, because of social media again, they're thinking, well, I can actually do, and we call these retail investors, people that can set up an account and they can do day trading, they can do options, they can do a variety of things. And we're not even talking about the stock market. We could also be talking about they could actually be investing in alternative investments, which we'll get into in a second. And I find this interesting because I will actually have this conversation with people and they will say to me, well, I had this conversation just the other day with somebody and they said, well, what do you expect? And I said, well, I don't really have any expectation on returns. Um, on one end of on the overall portfolio, yes, we're going to say conservatively, we believe we can get 5, 6, 7% over the lifetime of your life of 7 years, but not just in the market. And that person said, well, that's not very appealing because I've been making 30% in my option trading. And I said, oh, and I congratulated him. And I said, so tell me a little bit about it. I said, yeah, well, I placed these trades and then I'm looking at the next morning and then I'm looking at the next day and I'm looking at the next day. And I said, well, sounds like you're doing a lot of work. He said, yeah, it really is a lot of work. And so they actually enjoyed about our tax mitigation that we do. And so I said, well, send me your tax return and I will look at it and see if there's any way our tax department can help you with tax mitigation. Well, I saw, and they had $490,000 of investment losses on their tax return. And so this is the same thing that happens when people go gambling in a casino. They only remember their wins. They completely forget about their losses. And this is what this particular person, and this is not atypical. I see this all the time when people say, well, I did 15% in the stock market last year. Well, what did you do the previous 10 years? and because we don't want to feel bad about our decision-making process. And
Mm-hmm.
so we remember the wins. And that's something that you have to overcome by becoming self-aware. And it's also good to have a spouse. I tell people all the time, and I don't want to get in trouble here. It doesn't mean you have to have a spouse. I'm not saying that. I'm just saying you have to have a spouse or a trusted confidant that can hit you upside the head and saying, this is not what happened.
Yeah.
Yes, you did a good job last year, but what about the $490,000 we actually lost the previous 10 years? And because people don't want to admit they make a mistake. It's the same way why you want an advisor when times are actually in a turmoil that says to you, well, we have a tactical management strategy here that we are going to change sectors in times of turmoil, or we're still really confident in your portfolio. We are not going to make any changes right now, but we're actually going to buy more of that particular holding in your portfolio because now we're going to, what you said earlier, dollar cost average. And when we come back out of this rebound, we're actually going to take advantage of this by having more holdings that we bought at a lower price. So having that person, whether it's a trusted person that's just a relationship that you have, or whether it's a professional, is really, really important for you to maximize what you're doing going forward because you have rose-colored glasses. You only remember the good things.
There's so much in Proverbs about having wise advisors and a counsel around you, not making decisions on your own. So that's backing you up, Bruce. Okay, so as we stand here, we've talked a lot about the typical financial planning paradigm. A lot of the problems that we see overall with that are that you can be in a position of lack of control. What I mean by that is that if you are in a place where you are trusting someone else to make the investment decisions for you, you're not personally deciding which stocks, which mutual funds, which pieces that you want to pull together, and you're not making those decisions for yourself, you're not as much in a position of control. You're also not necessarily as much in a position of control if you can't access capital to be able to move that at a moment's notice into something that you know and you control so that you can make wise investment choices. We talked about taxes being a potential risk as well, specifically if you're using a carte blanche decision to defer, thinking that deferral is the best strategy because you're lowering your tax bracket this year. Then some of the risks are risk of losing money as you're in a position of that's what investments are. They have a high potential or they have a potential for return, but there's also a risk of loss. So you always have a risk of loss when you're working in the typical financial planning space. There's the risk of systemic market risk. There's the risk of timing. There's the risk of sequence of returns. And I know that we don't have time to get into that in detail. We have a podcast that you can explore more on that. But the general idea of sequence of returns is that if you take losses early in the timing of your trajectory, then it's much harder to recover from that, as opposed to having wins or gains in the beginning and losses at the end.
It's probably the thing that's not talked about. I'm actually shocked that our industry does not talk more about this. It is probably the biggest thing that can derail a portfolio and your success in retirement, if that's what you choose, is sequence of return risk. And you can do things to mitigate sequence of return risk by not by having money set off to the side so that don't have to go to your equity portfolio and draw money off of it when it's down. And Dr. Wade Fowle, who we've had on the podcast a couple of times, he's actually done extensive research on this, and he has a wonderful white paper on this. But there's some very simple examples of this, and it can really derail a portfolio if you do not take that into consideration. But like you said, probably it's you can either go back to the last podcast or we can deal with this in a future podcast. But right now it's too extensive to finish on our podcast today.
Absolutely. So another concern is that when you're in a position of potential of loss, you cannot truly have compound growth. So the challenge with compound growth means that you're preserving and holding and maintaining capital, and you're having a increase or a positive gain adding back to the principal. And if you're in a position of loss or taking out the principal, then you're not able to reap the rewards of that compound growth. Bruce, is there anything you wanted to add to that before we dive into the next portion? I know we're getting short on time here.
No, it's great. I mean, it's the old thing that money is not math. And you have $100,000, you lose 20% of it one year, you're down to 80,000. You gain 20% the next year, then you're at 96,000. But minus 20 plus 20 is zero. It looks like you haven't lost any money, but all of a sudden you've lost $4,000 in the actual return. And that is even more detrimental if you're taking money off of it to live off of for the next year. You're going to be even further behind.
Mm-hmm.
So that has to be considered if you want to have a successful retirement into the future, or frankly, if you want to have a successful accumulation phase too. You're not taking money off of it at that time, but you have to take that into consideration.
So when should you consider something different? We've talked a lot about what the typical paradigm is for financial planning, and maybe you're looking at your own strategy and you're saying, well, I do have a few concerns about that. I'm not sure if I'm ready to accept new information or consider alternatives, but let's just talk about what are some indicators that you might know that would be an opportunity for you to consider expanding the lens that you're looking at finance with. One is if you are concerned about stock market risk. One is if you want more control. Another is if you are interested in minimizing taxes, not just by postponing the tax bill to the future, but by reducing your tax liability today and going forward in the future. If you're concerned about having access to capital, if you want cash flow, not just paper net worth. And I think this is a really big one because you can have a dollar amount listed that is your net worth if you are looking from the typical lens and you're planning to then draw off income off of that pile of cash, if you will. That is a finite resource, though. If instead you're in a position of creating cash flow and your income is increasing because you have cash flow coming off of assets, you're in a completely different position. So, those are just some, I guess, gut checks. If you are resonating with anything that I just shared there, maybe that is an indication for you that you could explore something outside of the typical paradigm. And Bruce, I think it would be really valuable if just in the time that we have left, which we have about 8 minutes, if we could just talk about some of the alternatives that somebody could consider to really come back to the thing that you said in the beginning, to think expansively, not just segmented, not just compartmentalized piece of our financial life, but be able to do the whole thing better. Because I think that's ultimately what we all want. We want to feel wealthy. We want to be able to live wealthy. We want to enjoy our money today. We want to do the most with it. We want to be in a position that we feel confident about. And maybe you haven't even labeled it with the term, I want more financial control. Maybe it's just, I want to feel better about my money. I want to feel better about it today. I want to feel happier when I choose to spend it, that I'm not jeopardizing my future. You want more confidence. And so let's just talk about some of the alternatives outside of that typical window of financial planning.
First of all, everything has to start, I think, with your own emotional assessment of yourself personally. Um,
Absolutely.
it drives me crazy when I hear somebody say, "Oh, don't worry about the market going down; it'll come back." Well, that probably is true. I mean, historically that's true, but that doesn't mean the person that is feeling those emotions right now are not valid. Okay, so then the first thing we talk about some alternative things to consider is I'd like to talk about one thing to consider is not retiring.
Mm.
Okay, so that would be the first thing to consider. Retirement was made up basically in 1935 when we started the Social Security system, and then it was propagated by wirehouses, investment firms, banks, insurance companies to actually uh, to do marketing to have more money flow into their control. Okay, so think about retirement as a goal that a lot of people have, but they don't even know why they have that goal, other than
Mm-hmm.
somebody has told them that, or they're in a situation where they just don't like it anymore. So their goal is not to change their situation and go to another career or another job opportunity. Their goal is to just get out of all job and career opportunities and retire. Now, the first one alternative is business ownership. It's not for everybody. Okay. So you may not have the stomach because business ownership could actually be volatile like the stock market. The difference is you're in control of your destiny for the most part because you're actually working in the business. The other one, you're hoping that the people working in those businesses are actually producing good things. So one's hope, one's actually you have some control. Real estate. Traditionally, real estate has been very, very good. I've had a dozen rental properties over my career. I now have none. They were good when they were good, but they were taking way too much of my time away, so I got rid of them. Now I actually do real estate, but I do it in funds. I don't hold the physical real estate. Another one would be gold and silver. But as you've documented, you're in Lucas's journey with gold and silver. Gold is a place that you can store value, but that value is still volatile. People say, well, it'll never go to zero. Well, that might be true, but that doesn't mean it won't plummet in value.
Mm-hmm.
And at that time, it plummets in value when you might need it. It's no different than when a stock plummets in value and you sell it. You sell it at a loss. Life insurance would be another alternative investment than typical um, financial planning. And there's some advantages to that, but once again, there's some challenges to that too. You have to qualify for it to go through that. Alternative investments that are outside the stock market that might include private equity, private lending, hedge funds. It might can be some partnerships that you actually invest in outside of the stock market. Tax planning. Maybe we don't have to grow your money as well if we can help you keep your money more in the form of legal tax mitigation. I've said this before. One of the things that opened my eyes up about 15 years ago, I went to a conference and there was a ex IRS compliance officer there, and he made this statement that 5% of the tax code is about how you pay taxes, and 95% of the tax code is about how you don't have to pay taxes. And yet we all focus on the 5% about how we pay taxes. So having a good tax strategist could actually help you take some risk out of your portfolio.
Bruce,
Because
I'm just going to pause.
every dollar, let me finish and then you can go
Yeah,
ahead. Every dollar that you save in taxes is another dollar that you can invest, you can spend, or you can give away.
absolutely. Bruce, I love that we're talking about these items because sometimes people say, I just really want something more tangible. I want something that I can hold, that's physical, that's more than just a stock. It's more than just paper money. It's instead physical gold and silver, physical real estate. Maybe it's a physical thing that they can touch and hold. So that can sometimes be a reason why you would want to consider some of these alternatives. And Bruce, I also love that you mentioned business along with the tax planning. You have so many more tax advantages that you can access when you have businesses and real estate. So some of these are compounding with the added benefits that you get. It might not just be more control, more cash flow, or potentially a position where you have a physical asset that you're owning, you might also have tax advantages in addition to that.
Yes, absolutely. That's really, really important. And then to finish up, using an insurance company, possibly for annuities to protect not only the downturns, but then to provide a income flow guaranteed by the insurance company for the rest of your life or a period. That would be another thing that would be outside the stock market. Estate planning, so that your portfolio that you have is not eroded to the next generation. Um, and also not eroded from possibly creditors in that situation. And then legacy planning does not include just money, but also about your family's ideas and philosophies that you want to pass on to the next generation that will help them get a leg up and not have to learn everything again from the beginning.
Bruce, I really love that you mentioned estate planning, and this comes into the category of protection that you mentioned earlier, where you were segmenting out this pie of different areas of financial planning. And if you're just trying to move forward, but you're not protecting what you have, you're in a really challenging position, because if what you have can be lost, you have a unstable foundation that you're building your financial house on. And so estate planning, something we even didn't mention here, is just looking at overall your insurances, things like your liability protection, your auto, your homeowner's insurance, disability.
Long-term care.
Yes. So you're looking at these areas of being able to have this protection built into your financial life that then allows you to keep and maintain and retain more of the money that you have made in the first place. And so as we're talking about these ideas, we're expanding the conversation from this little piece of the pie that is usually called financial planning, and looking at the full spectrum of all of the money that is happening and flowing in your life, and really considering how you can do all of that better. And so that's why we talk about banking so much on this podcast as well, because everything that you do does involve money, and every piece of money, every dollar that comes into your hands flows somewhere. And it's really thinking about, where's that money sitting? Where is it flowing? Who controls the reservoir that it's sitting in? And so I hope this conversation today was piqued your interest, your curiosity. Maybe this was something that was confirmation of some of the questions that you currently have, or some of the doubts or the concerns that have arisen in your own heart and mind about your financial life. And we would love to be able to talk to you and be able to help you make decisions from where you are right now, to think expansively, think abundantly, and be able to be in a position of doing the most with the money that you have. So if that's you and you want to have that further conversation, you can hop on over to themoneyadvantage.com. You can book a call with our advisor team and start that conversation about your personal finance. But even bigger than that, I really hope that you leave this conversation today looking for an opportunity to become more knowledgeable, more educated, really put details and feet and information into your financial wheelhouse, so you're making decisions based on not just logic and facts, but you're looking at the full range of options. You're not just staying limited to that little slice of the pie that most people call financial planning. Bruce, thank you so much for joining me for this conversation today, and we invite your questions. In closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.